explain why you believe investors shouldn't have access to this information?
And I mean, in general, it comes down to the company's decision as to
30% of investors wanted to know if senior management was diverse, how these institutions are impacting climate change, how that's increasing costs and deadly natural disasters.
information is material,
All right,
not depending on what the proclivities of one or another.
I got it. You're sticking to it.
Lady for yielding, and the gentlewoman from Massachusetts, Ms. Pressley, is now recognized for 5 minutes.
Chair Atkins, I've read an article where you once said, quote, "The ultimate boss is the investor," unquote. Do you still stand by those words?
As far as the markets go, that's definitely true.
Well, I think we can all agree if bosses are to make good decisions, they need to have access to good data. Unfortunately, as the head of SEC, you are denying investors access to information. You're changing the rules that have been put in place by limiting what data is provided to investors and reducing how frequently data is provided to investors. Now, I've had colleagues across the aisle complain about information overload and, past bills. Colleagues so often, investors only have access to quote-unquote material information. The problem with that approach is that Republicans are arbitrarily choosing what information is material and immaterial to investors. Now, I've been on this committee 8 years since I arrived in Congress, and I know that investors care about a wide range of information, ranging from executive compensation to costly climate-related disasters like floods and fires. So I want to focus on diversity disclosure specifically. The SEC approved a rule that required public disclosure on the race and gender of board of directors. Now, this information was important to investors because study after study has confirmed that diversity is good for your bottom line. It is good for business. So can you explain why you believe investors shouldn't have access to this information?
Investors should have access to material information, and I mean, in general, it comes down to the company's decision as to what they believe is material or not. And because again, it's for the reasonable investor, it's not for particular investors to as the rubric. That's the way the court has ruled. So anyway, so our rules are geared to the company, and it requires companies, issuers, to disclose material information to the public. And so,
Well, I'm running. Okay. Well, I'll reclaim my time. I just, again, in order to make good decisions, you have to have good data, and the majority of investors are saying that they want this information, and many reports and CEOs have affirmed that diversity is good for business and for the bottom line. So that answer is insufficient for me, and I just, again, a study of institutional investors that handle hundreds of billions of dollars have found that 30% of investors wanted to know if senior management was diverse. So that means roughly 1 out of 3 investors consider this information important. So I think that makes it material. Disclosures about board diversity, climate risk, use of AI are essential for investors to make smart decisions. After all, in your words, the investors are the ultimate boss. So to reiterate, bosses need data to make decisions. Now, that's why I am reintroducing the Greater Supervision and Banking Act, or GSIB, to mandate disclosures by the biggest banks, Bank of America, Wells Fargo, JP Morgan Chase, Goldman Sachs, and others. Investors and consumers alike deserve to know how these institutions are impacting climate change, how that's increasing costs and deadly natural disasters. Investors deserve to know whether these banks are rewarding themselves with large executive bonuses, and investors deserve to know that the board of directors at these companies represent them and their interests. They deserve it and they want to know. Chair Atkins, can you commit to finding a way to ensure this information is available to investors when 1 out of 3 say this is what they want? Can I count on your partnership?
Well, again, so the court has held that information is material, not depending on what the proclivities of one or another.
I got it. You're sticking to it. I was Chair Atkins, I'm trying to give you a win here. You don't have a stellar reputation on this front. The 2008 Great Recession, when you were first a commissioner at the SEC. But we don't have to go back decades. I mean, just a few years ago, you were advising FTX when that company collapsed. So I really saw this as an opportunity for partnership, for you to redeem yourself there, Mr. Chair. I was trying to give you an easy alley-oop. I do believe we need fair, orderly, and efficient markets, and the American people deserve that instead of another global financial crisis. I yield back.
I thank the gentlelady for yielding. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Atkins, it is good to see you, and thank you for appearing before the committee. I appreciate your engagement with Congress as we work to restore a regulatory framework that supports competitive capital markets and long-term economic growth. After several years of rapid expansion in the SEC rulebook, it is encouraging to hear you mention that some regulations have become bloated and, in certain cases, obstacles to capital formation. You've indicated that the Commission is now focused on reducing unnecessary compliance burdens while preserving strong investor protections. I agree with that goal and want to begin by discussing how the Commission is addressing recent rulemakings that impose significant costs with limited benefits. One example is the 2023 Fund Names Rule Amendments, which the SEC estimated would affect roughly 66% of funds and add substantial compliance and operational costs, ultimately borne by American savers. So my question is this: consistent with your goal of reducing unnecessary burdens, how is the Commission or its staff reviewing or addressing these prior rulemaking excesses, and what principles are guiding your approach to recalibrating rules that may have gone too far?
Well, we're undertaking that in all of our divisions with respect to reviewing old rules, and in particular the Corporation Finance Division, with respect to Reg SK, which is kind of the bedrock of corporate disclosure. But you've named others as well with respect to mutual funds and whatnot. So all of those add costs to investors. Ultimately, they bear the cost, and so we have to have it's good to have a retrospective view of that to weed out things that are not really fit for purpose.
Thank you for that. Let me now turn to public company disclosure and capital formation. I understand that last year the Commission received a proposal from a U.S. stock exchange requesting that the SEC initiate a rulemaking to allow for optional semi-annual reporting for public companies. The goal was to reduce reporting burdens and short-term market pressure while fully preserving material disclosures for investors. This proposal closely mirrors what President Trump called for last fall as a part of a broader effort to spur initial public offering activity and encourage more companies to access our public markets. At a time when fewer firms are going public and staying public, it is worth examining whether our disclosure framework has become overly focused on short-term results at the expense of long-term growth. Can you share how the Commission is thinking about potential changes to the public company reporting framework, including possible approaches to reducing short-term reporting burdens?
Yes, well, I've announced that we're looking at that. This debate has been going for now a few decades. The requirements started out as annual reporting up until 1955 when it went to semi-annual, and then in 1970 went to quarterly, and then the UK, which kind of followed suit with us, changed back to semi-annual in 2014. So we're looking at all of this. I'm agnostic on this. We want to hear comments from people as to what's the best. We were considering doing this for smaller companies where perhaps semi-annual might be more appropriate for them. But we'll be seeking comment on all of this.